Welcome to the Hurst Trading Room. This is our video update for the 4th of March 2013. The markets recently have been in the grip of a dominant cycle, in my opinion, and that dominant cycle is in the process of turning, so we're in for an interesting time in the markets. And so in today's video update, I'm going to spend a bit of time speaking about the concept of a dominant cycle in the markets and what's happening in those markets in terms of us identifying our trading opportunities. I'm also going to look at two markets from the other side of the sea, from the United States. I'm going to take a look at Euro stocks and also the FTSE 100 to give us a different perspective in terms of what's happening in stock markets around the world. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. Let's start by taking a look at the SP 500. You will know that last week we were in a short trade in the SP 500 as price had crossed down the week before below the 20-day FLD over here, and that was a probable B category short trade. Our T1 target was reached the day after entry, and so we thereby reduced our risk to 1/6 of the original level of risk. And so instead of risking about 2% of our fund, we were risking only about 1/3 of 1%. Monday was an interesting day because the market went up and took us out at our adjusted stop loss, and so we exited from that trading opportunity at a small loss, and then the market went all the way down again. Sometimes it happens. The market does that, it thrashes around, and it's particularly interesting because when you see the market moving around with a great degree of volatility like that, it is often an indication that the market is in the process of forming a peak, which is of course exactly what I think it is doing. Peaks can be very volatile periods, and you often get the emergence of shorter cycles as dominant cycles around about the time that markets are forming peaks. So it's another indication that the market is very probably forming its top at the moment. What would have been the next trade? The next trade would have been a long C category trade, but given the fact that we have a 20-week dominant cycle, which I'm going to speak about in a moment in the SP 500, and the fact that that dominant 20-week cycle has almost certainly turned down, I was not interested in entering into a long C category trade. Price came back up to the FLD, as you can see, Wednesday and Thursday of last week, and it dropped below it on Friday, and it has probably just crossed over it today. I'm recording this on Monday morning, Central European time, so the markets aren't open yet in the United States, and so it's too early to say whether it has in fact crossed back up above the FLD. But even if it has, I'm not interested in entering into a long trade, and there are several reasons for that, which mostly have to do with the dominant cycle and the effect of the dominant cycle. So let's speak a bit about that. I'm going to zoom out here. And here we go. Let's turn off trading so we can concentrate for a moment on the analysis. As you know, the analysis that we've been tracking in the SP 500 has been positioning the 20-week cycle trough here in mid-November, so that's the 20-week trough. I'm not going to spend too much time giving the bigger picture because I've been doing these videos every week for some time now. And if you're not sure of the context, then go back and look at some of those previous videos. In the Nasdaq, we're going to speak about the alternate analysis, which positions the 18-month cycle trough in the middle of November. But as you know, the S&P 500, I'm using to keep an eye on this analysis, that the 20-week cycle trough occurred in the middle of November. There was a good clear cycle over here, as you can see, which according to this analysis is a 40-day cycle. There's the 40-day cycle trough right at the end of 2012, so that's the 40-day cycle trough. Now you will know that that is one of the signs of a dominant cycle, and again, I'm not going to explain it in great detail in this video. I've been writing about it recently in the blog. on sentienttrader.com. So make sure that you take a look at that blog. I write a blog every Saturday, and recently I've been focusing on the concept of dominant cycles, because that is exactly what's happening in the markets at the moment. So when we saw a very clear 40-day cycle take place between the middle of November and the end of December, it was an indication that the 20-week cycle was probably dominant. The next thing that you need in order to confirm the dominance of that 20-week cycle is a subtle trough of the 80-day cycle. And here is that subtle trough of the 80-day cycle. You can see I've pinned it slightly earlier than I had it last week. Last week I was considering the first week of February as the correct position for that 80-day cycle. At the moment I've pinned that slightly earlier, and there's a good reason for that, which I'll explain in a moment. But whether it was in the last week of January or the first week of February, it is very clearly a subtle trough. And I spoke last week about subtle troughs, and I've been writing about them in the blog as well. So make sure you read all of that and take a look at that, so that you understand the concept of a subtle trough. But very simply, it's a trough that's difficult to identify. And often the price move down into the trough elapses over a very short period of time, and it's not a substantial price move down. And so that is clearly what happened. Whether it was in the last week of January, the first week of February, is debatable, but certainly sometime in this time period over here, we most probably saw the formation of a subtle 80-day cycle trough. And one of the things that you often see following a subtle trough, and when you have a dominant cycle, is you will see a straddled trough 1 degree shorter, which in this case is the 40-day cycle. I spoke about all of these things last week, I think, or might even have been the week before I spoke about these concepts, and so there's nothing new here. So we have been looking for a straddled 40-day cycle trough. And the reason why I've moved my 80-day cycle trough 1 week earlier is because it looks very likely that that 40-day cycle trough formed last week. Okay, so there it was on Monday of last week, as price came down really hard. That 40-day cycle trough most probably formed. So that's it over there. So that's the trough of 40-day magnitude, and of course we expect it to be a straddled trough, which means that price action surrounding that straddled trough is likely to be fairly symmetrical. I spoke about this last week as well, and so there was price coming up to the peak before the straddled trough, came down into the straddle trough. We'd expect symmetrical price, so it was no surprise when price bounced up fairly strongly last week, because we expect symmetrical price action. And of course that symmetry should continue and take us down below the 20-day FLD. So the markets are playing out really exactly as we expect at the moment, and that is because there is a 20-week dominant cycle. And so this concept of a dominant cycle is really very important. If you haven't reached module 4 yet of the FLD trading strategy, then the concept of a dominant cycle is something that you haven't started working with yet. You'll start working with it in module 4, and of course module 5 we speak about it in greater detail, and module 6 has even more about dominant cycles, in particular how to determine what cycle is dominant, which is a very important thing. This use of the 40-day cycle here is one simple trick, but you can't always identify short cycles to identify the longer dominant cycles. So the markets are playing out exactly as expected. In terms of trading, what are we expecting next? Well, I am expecting price to drop down below this FLD, and I will enter into a short trade at that point. Whether that will be an F category short trade or whether it will be a D category short trade doesn't bother me too much at the moment. As you can see, the analysis here, I've written that was probably a 40-day cycle trough that we saw last week. If that was a 40-day cycle trough, then we're in for an F category short trade, which is likely to be a very profitable short trade which will run for quite a long time. If in fact the 40-day cycle trough hasn't formed yet, which is still possible, then we'll be entering into a D category short trade, which is not expected to run for such a long time. The entry into the trade is identical to all intents and purposes, and so we will be looking at entering into that short trade. Let's just zoom in here a little bit, and I'll point out to you that, of course, today in the after hours trading, or the before hours trading you might call it, because the markets haven't opened yet in the US, price has come back down to the level of the 20-day FLD. Now, I did not jump into a short trade at that point, because today is a Monday, and I have rules about Monday trading, as you know. I don't enter into trades on a Monday unless the price action is so strong that that it warrants entering on a Monday. You should be familiar with the Monday rules by now, and I might consider entering at the level of Friday's low, but there is a more interesting level that is available to us this week, and let's just zoom out a bit and take a look at that. And that has to do with a trend line. Now, it is not a valid trend line, and so I use this chart overlay tool, which is a very useful tool for drawing trend lines. And so we can draw a trend line between those two troughs over there, and that trend line provides us with some useful information, because although the FLD is around about that level over there for the rest of this week, this trend line is coming up, and I would not be surprised to see price interacting in some way with this trend line, either coming down, finding a bit of support, bouncing back up again, or, of course, very importantly, crossing below that trend line. And so I'm going to keep an eye on that trend line as well. As a matter of interest in Cent Trader, if you're keeping a trading journal, you can use this chart overlay tool, of course, to snap a quick image with that trend line and add that image into your trading journal. And so you have it for reference later as the price action unfolds. So that is what is happening in the S&P 500. Let's take a look at the Nasdaq. First of all, last week we were in a short trade in the Nasdaq, and it was, in my opinion, most probably a short category F trade, and our T1 target had been taken out on the day of entry, so we'd made a small profit there. And our T2 target was taken out the very next day, and at that point, of course, we reduced our stop loss, lowered our stop loss to the level of entry, so we had a break-even on our trade 3. That break-even was taken out in Monday's volatile price action, as you can see, and so we exited from that trading opportunity with a good profit. We had our profit from trade 1 and from trade 2, and we broke even on trade 3. So we exited from that trading opportunity with a profit, and price then came down to form what was expected to be the 20-week cycle trough. There is the nest of lows for the 20-week cycle trough, and in fact it very probably did form that 20-week cycle trough last week. Now that doesn't look like a very prominent trough for the 20-week cycle, and of course we could have entered into an A category long trade as price bounced out of that trough at the level of the 20-day FLD, which was at the level of 27.20, and in fact our T1 and T2 targets would both have been reached for that long trade, and so it would have already proved to be a profitable trading opportunity. I didn't do that because although the rules state that you should always try to get into a trade, they also state that you should always keep an eye on what else is happening in terms of the analysis. And I was expecting a subtle 20-week cycle trough, and following a 20-week cycle trough, which is subtle or possibly hidden or maybe even straddled. Those are all versions of a subtle trough, as you probably know by now. Following a subtle trough of the 20-week cycle, I'm not expecting great things out of the market. And if this turns out to be a straddled 20-week cycle trough, which is still very possible, then of course I would expect price to be fairly symmetrical. So I will expect price to come up to about the level of the previous peak before falling down again. It might still do that, but I am very concerned about the weakness in the markets at the moment. You probably know, certainly if you keep an eye on my blog that I write every Saturday, I'm concerned that the markets are vulnerable to a strong fall, and so for those reasons I didn't enter into a long A category trade. I would have made a small profit out of it if I had, but I'm more interested really in catching the bigger moves rather than constantly trying to get in to make very small profits. I'd much rather catch the bigger moves, and I believe the bigger move in the Nasdaq is going to be a downwards move. And so of course that will most probably be a B category short trade. I don't often enter into B category short trades except following the formation of a subtle trough, which is exactly what has happened here. So now, why was I expecting a subtle trough to form in the Nasdaq? The reason for that also has to do with the dominant cycle. So let's speak about the dominant cycle in the Nasdaq as well. I believe that the dominant cycle in the Nasdaq, according to this analysis, and that's something that I keep saying because it's very important to remember that all the decisions you're making are based upon an analysis that has been performed. So according to this analysis, the dominant cycle in the market is, I believe, a 40-week cycle. Now, you could debate whether it's a 40-week or a 20-week cycle. Let me present some aspects of that argument to help you make your own decisions. First of all, this analysis tracks, as I've mentioned already, the analysis which has the 18-month cycle trough in the middle of November. And that's a very possible, very viable analysis. In that case, the trough which formed right at the end of 2012 is, according to this analysis, a trough of the 80-day cycle. Now, why is that a trough of the 80-day cycle as opposed to a trough of the 40-day cycle? In the S&P 500, that is a trough of the 40-day cycle. Well, let's quickly measure the bars. There are 45 bars between those two cycle troughs. So one could debate whether that is a long 40-day cycle. The average length of a 40-day cycle is in fact 34 days. So that might be a long 40-day cycle, or it might be a short 80-day cycle. And which one of those is more likely? Well, according to this analysis, with the 18-month cycle trough in the middle of November, the underlying trend of both the 40-day and the 80-day cycles was positive because you had so many cycles pushing upwards. When you have an underlying trend which is positive or bullish, you must remember that troughs are expected to occur early. So to answer the question, is this an early 80-day cycle trough or a late 40-day cycle trough, the chances are more likely that it was an early 80-day cycle trough because the underlying trend was bullish. And that is why this analysis has an 80-day cycle trough at the end of December 2012. Now we see a good, a very clear cycle shape here for that 80-day cycle. And that gives us a very good indication that there is a 40-week dominant cycle active in the markets at the moment. And so the next thing that we expect when there is a dominant 40-week cycle is, of course, a subtle 20-week cycle trough. All of this kind of thing I've been speaking about at some length recently, so I won't dwell on it, but we expect a subtle 20-week cycle trough to form. And it looks as if though that subtle 20-week cycle trough did in fact form last week. As I've mentioned, it could be a hidden trough or a straddled trough. At the moment, it doesn't look very hidden. It could certainly develop into a straddled cycle trough. Okay, which would imply a fairly symmetrical price action. Is it possible that the price rises over and price is going to turn down and go down immediately? Yes, it is possible. That is symmetrical enough for it to be a straddled trough. So what we're looking at next in the Nasdaq is a short category B trading opportunity as price crosses below the FLD. So something interesting is also happening in the Nasdaq at the moment, and it provides an example of how often when you're analyzing markets using Hurst's cyclic principles, all the pieces of the puzzle fall into place. And I want to demonstrate this to you, because when that happens, it's a very rewarding thing. Let's take a look at the level of the 20-day FLD based on the median price, of course. That is today at a level of 2702.75. 2702.75. And now let's take a look at one of the other cyclic tools that Hurst defined. That is the VTL. There is the 80-day VTL. So that is a valid trend line. Notice that that valid trend line is in fact the same trend line that I drew on the SP 500 chart. It connects this trough here at the end of 2012 with the trough last week. Okay, in the SP 500 it was not a valid trend line, but it was a trend line, of course. And in the Nasdaq it is not only a trend line, it is also a valid trend line, and it is a trend line, a valid trend line of the 80-day cycle. So what is the level of that 80-day valid trend line? We double click here and we can read it off the information box there. The level of that valid trend line is 2702.80. There is less than one tick. In fact, there is 1/5 of a tick difference between the level of the FLD and the VTL. And so that's really interesting, because the FLD and the VTL for today are providing exactly the same level, 2702. 2702 is probably a really fairly important level, certainly for today. So what are we going to do? Well, if price gets down to that level at 2702, I would probably enter into a short trade. Of course, you must bear in mind the Monday rules, and the Monday rules are rules that are fairly personal, depending on whether you want to enter into a trade at a particular level on a Monday. If price gets that far down today, I would enter into the trade. Tomorrow the FLD kicks up quite high, as you can see, and reaches a bit of a peak on the Wednesday. So the FLD will be providing us with a tighter and tighter level of entry. Because we have that very interesting valid trend line over there, I would actually watch that valid trend line through this week, and I will be setting my entry levels at the level of the valid trend line. I believe that the 40-week cycle is dominant. I think the Nasdaq is going to be moving down for some time, and there isn't a lot of difference between the FLD here and the trend line, and so I will be keeping a close eye on that trend line, because I think that trend line gives a very interesting entry level. Of course, strictly according to the rules of the FLD trading strategy, you would enter into a trade at the level of the FLD. So we'll see what happens today, but certainly I think that this week could be very interesting for the Nasdaq. We must be aware that this 20-week cycle trough could turn into a straddled trough, which means the price might bounce up to roughly the level it was at about 2 weeks ago, and it could go even higher than that. It's not impossible, so we need to be a little careful of that. And with that FLD coming in right into the price level that it's at the moment this week, we need to be careful of getting stopped into this trade too early. But certainly next is going to be a short trade in the Nasdaq. Let's take a look at the euro to US dollar. In the euro to US dollar, I've been tracking two possible analyses. One of those analyses I call my short cycles analysis, because it positions the 80-day cycle trough here in the first week of January, and that was a very short 80-day cycle. Okay, so this is my short cycles analysis, and on the basis of this analysis, 2 weeks ago we entered into a short trade as price dropped down, fell away from that FLD, the 20-day FLD, and our T1 and T2 targets were taken out, and so we took profits from T1 and T2, and we are now implementing the 3-bar trailing stop. As you can see, there's our 3-bar trailing stop. So we're in a very profitable short trade in the euro to US dollar, and that is, of course, as the euro to US dollar comes down to this 20-week cycle trough over here. In fact, it's not a 20-week cycle trough, it is a 40-week cycle trough. You simply can't see the circle and whiskers for the 40-week cycle, which are off to the right hand side of this chart. So that's a 40-week cycle trough that the euro to US dollar is moving down into at the moment. What's going to happen next? Well, of course, our next trading opportunity in the euro to US dollar is going to be an A category long trading opportunity as price bounces out of the 40-week cycle. I believe we need to be a little bit careful not to get into that trade too early. Bear in mind that on the way down we can often see double GH interactions, and this was a possible first GH category interaction over here, although in fact I believe that was a distorted F category short trade over here instead of a GH. And so in fact the first GH that we saw was as price moved back towards the 20-day FLD and then fell down again, which it did last week. So that was most probably our first GH category interaction. We might have a double GH interaction happening at the moment, or at least happening soon, before we get the A category long trading opportunity. So we must be careful about that. When do we expect that A category trading opportunity to take place? Well, as you can see, let me clear this, there have been 59 bars since the 80-day cycle trough at the beginning of January. So another 9 days and we will have an average length 80-day cycle, and there have been almost 16 weeks since this 20-week cycle trough in the middle of November. So another 3 weeks also, and we will have our average length 20-week cycle. And so yeah, that's anything from 10 days to 3 weeks time. So if price rises back up to the 20-day FLD this week, I'm not going to be jumping into my A category trade, because I'm expecting 10 days to 3 weeks still to play out before this 40-week cycle trough forms. It is a 40-week cycle trough, and so we do need to be wary of jumping in too early on the basis of the 20-day FLD. On the other hand, there is not a lot of bearish pressure in the market at the moment, and so we might not see a good, clear double GH interaction. We don't require a double GH, because double GHs occur only when there is a bearish underlying trend generally. So we don't have to see a double GH interaction, but certainly I'm not going to jump into an A category trade this week. I'm going to give the market just a little bit more time to play out before I'll get into that A category long trade. As a matter of interest, what is the dominant cycle in the euro to US dollar, seeing as we are speaking about dominant cycles this week? Well, there's an interesting story that is being told by the euro to US dollar in terms of the dominant cycle. So let me spend a moment speaking about that. First of all, you know that a simple trick for identifying a dominant cycle is to is to find a clear cycle, and we had one here, and that was, of course, the 40-day cycle, which implies that the cycle 2 degrees longer, in this case the 20-week cycle, is possibly dominant 20-week cycle. But that is only the first clue that we get to the dominance, that's the cycle that is dominant in the market at the moment. The next thing that is required in order to confirm that the 20-week cycle is dominant is that the cycle 1 degree shorter than the potential dominant cycle, in which case, in this case, the 80-day cycle, should form a subtle trough. And we've seen that happening in the SP 500 and in the Nasdaq. And did it happen in the euro to US dollar? Well, here is the 80-day cycle, and the answer is no. Under no circumstances could you really consider that to be a subtle 80-day cycle trough, and so the dominance of the 20-week cycle proved probably not to be valid. However, the fact that we got a clear cycle showing itself in the 80-day cycle told us that most probably the 40-week cycle was in fact dominant. Is it possible that the 40-week cycle is dominant? Well, for the 40-week cycle to be dominant, we need to go back to the previous 40-week cycle trough. Here it is over here. And we need to find a subtle 20-week cycle trough, and that's this trough over here. Is it subtle enough? In my opinion, I would say no, it isn't really subtle enough. Although it isn't an extremely prominent 20-week cycle, but it's not a very subtle one. So there is an indication that the 40-week cycle might be exerting some form of dominance, but it's not really very clear. And so I would not emphasize or focus too much on the dominant cycle at play at the moment in the euro to US dollar, because I believe it's simply not clear enough. I'd like to show you another interesting trick which is directly related to the concept of dominant cycles, and that is the fact that you can work out what cycles are proving to be dominant not only in the way that we usually analyze markets, which involves synchronized troughs, but you can also look at the peak-to-peak distances. And in the euro to US dollar, the peak-to-peak distances have been, interestingly, very clear, and there's been a clearly dominant 20-week cycle in the peak-to-peak distances. So, and I've got a bit of a sort of a punchline to this story, which I'm going to come back to. So let me first of all show you what I mean. Now, we're so used to looking at markets this way up with synchronized troughs that when I start speaking about peaks and distances between peaks, you might find it initially just a little difficult to grasp, because you're looking at the market upside down, if you like. But let me show you how you can use the same trick to work out when the dominant cycle in the market, because it is only one dominant cycle, but when that dominant cycle is likely to form a peak. And this is what happened in the euro to US dollar. First of all, let me show you what I'm going to do. There was a clear peak in the euro to US dollar over here in September. There was also a clear cycle that played out into this peak in October. So now you know that the trick is you measure the distance, or the peak-to-peak distance. We're used to measuring trough-to-trough distances, but you can do the same thing with peak-to-peak distances. And then you take the cycle 2 degrees longer, and that tells you what cycle is dominant. So let's measure that distance, and we can do it here. And that distance, as you can see, if you've got good eyes, is 30 days, 30 bars. Okay, 30 bars is, of course, a 40-day cycle in Hurst nominal model terms. So that's a 40-day cycle. So that is also telling us that the 20-week cycle is most probably dominant. And remember, when I was measuring trough-to-trough distances, we also got the answer that the 20-week cycle was probably dominant. What does that mean? Well, as you know, there can be more than one dominant cycle, and because of that fact, often dominant cycles can be dominant, but they're just not that clearly dominant because there are often many dominant cycles. So it is fairly obvious that there is a 20-week dominant cycle in the euro to US dollar at the moment. Let's see what that would have told us in terms of peak to peak distances. The average wavelength of the 20-week cycle is, as you should know, 136 days. That is the average wavelength of the 20-week cycle. As soon as we had identified this very clear cycle shape over here with a 40-day cycle between the peaks, so from that peak to that peak, I've made a mess of this drawing. Let me redo this, and let me get rid of that. Okay, so once we had identified this as a 40-day cycle, we could say, okay, 20-week dominant cycle, 20-week dominant cycle. That means, therefore, we expect the next peak to be in roughly 136 days, 136 bars. And here's the really good news about this. I measured the distance between those peaks, and you can see there were 140 bars. Okay, so the peak in fact only came 4 bars later. So that is a very useful tool. Identifying the dominant cycle in markets is a really useful tool, not only in terms of when you next expect your troughs, but also in terms of when you can expect your peaks. Okay, so a really useful little tool there. So because the peak to peak distance was indicating that we had a dominant 20-week cycle, when the trough to trough distance between November and the December trough in the euro to US dollar, when that also indicated a 20-week dominant cycle over here. Okay, that was a 40-day cycle, as you can see, because of the position of the trough markers. So again, you know, we were looking at a 20-week cycle. So most probably the 20-week cycle is dominant. As I pointed out, you would expect a subtle 80-day cycle trough. Didn't happen, but nevertheless, you know, you can see a fairly clear dominant 20-week cycle. So that is the story in terms of the dominant cycle in the euro to US dollar. What does that really mean in terms of our trading? Well, it means that most probably the dominant cycle, whether it is a 20-week cycle or whether it is a 40-week cycle, most probably that dominant cycle is pushing the market down into this trough at the moment, which is why we're getting a good clear run of it. All right, so be careful of jumping into a long trade bouncing out of that trough, because you do have a powerful cycle, and that's what a dominant cycle is. It's nothing more than a powerful cycle pushing that market down. All right, and of course, when finally that trough does form, we will enter into an A category long trade as the market bounces out of that trough. Let's take a look at the British pound to US dollar. I have much less to say about the British pound to US dollar than I have had to say about other instruments. And the reason for that is because, as you know, over the last 2 weeks, I have stepped back from the British pound to US dollar. I haven't been trading it. And that is because of the extreme power of the dominant cycle, which has emerged recently. And that dominant cycle is most probably the 40-week cycle, which is pulling the market down very strongly. You might argue that the 20-week cycle is also fairly dominant. You would be right in saying that. The 20-week cycle is certainly fairly dominant, and both of those cycles are pushing the market down fairly strongly. And so in terms of what we're expecting next, well, we're expecting price to come down and form the 18-month cycle trough. It needs to form some troughs on the way down. In fact, round about now, as you can see from this nest of lows, we're expecting a 40-day cycle trough to form in the British pound to US dollar. And price will bounce out of that, might even come right up to the FLD, might give us what would be an E category long trading opportunity, but it is not a long E category trading opportunity that I will be taking, and the reason for that is because of those dominant cycles which are pushing down so hard. And certainly if I did take that E category trading opportunity, I would enter it at very low risk, because you have to keep in mind what else is happening in the markets. Of course, here is the nest of lows for that 18-month cycle trough over here, which is now expected around about the middle of April, as you can see. So what has happened in this analysis recently is that, as you can see over here, there have been 109 bars since this 20-week cycle trough which formed in the middle of November. Now, 20-week cycle troughs formed in most of the markets that we've been speaking about, if not all of them, in the middle of November. So it's no surprise that that is a trough of the 20-week cycle. And there have been 109 bars since that trough formed. That is too many bars for this to have been an 80-day cycle. So this here, this move here, cannot be an 80-day cycle. It's too long. That means that there must have been an 80-day cycle trough that has formed sometime within this falling price move. That is, of course, a subtle, or in this case, a hidden 80-day cycle trough. And you can see in this analysis, which is the default analysis, I haven't pinned any troughs. In this analysis, that 80-day cycle trough has been positioned in the last week of January, last few days of January. Last week, I was speaking about it potentially having formed in the first week of February, and in fact we entered into an A category long trade following that trough, which turned out to be a small profitable winning trade, which you would expect coming out of a subtle or hidden 80-day cycle trough. You expect your A category trade to be a profitable trade, but of course, as it turned out to be a hidden trough, we had to be very quick and very nimble getting out of it. And so that's what has happened recently. That 80-day cycle trough has been positioned over there. So now, how much longer do we have to wait until the 18-month cycle trough actually forms in this market? Well, I've just counted the number of bars. There have been 35 bars since that most recent 80-day cycle trough. So we therefore expect about another 30 bars until the next 80-day cycle trough. So that gives us about a month. And as you can see, there have been 15, almost 16 weeks since the 20-week cycle trough. So we're expecting another 3 or 4 weeks there as well. And since the most recent trough of the 40-week cycle, which was over here, there have already been 39 weeks. So the distance in terms of the time since the 40-week cycle trough, that warns us to expect the 18-month cycle trough fairly soon. But the other two more recent cycle troughs, the 20-week and the 80-day, tell us to expect another 3 or 4 weeks. So similar to the euro to US dollar, we're expecting another 3 or 4 weeks to elapse before we get into our A category trading opportunity, which would be our next trading opportunity. Of course, there might be a small E category trading opportunity playing out within the next week or two as price crosses above the 20-day FLD. And as I mentioned, I wouldn't be very keen on getting into that. I might take a small risk position in that, because it's just possible that we might see price bouncing out of that 18-month cycle trough already. But a more sensible approach would be to wait a few weeks until we get into that A category long trade in the bridge pound to US dollar.